Okay, welcome back. Today we'll launch into the second half of the course, which I personally find more fascinating, but that's just because I come from macroeconomics. But I think you might enjoy it more this year because there's a lot of new ground to cover in the world economy, and you can interpret current events using the methods we're going to teach or relearn quite easily. So let's give an overview of today's talk, today's lecture. We're going to talk about this dichotomy of macroeconomics of the small open economy into those economies that have decided to fix their exchange rate, the external value of their nominal means of payment, vis-a-vis a basket of foreign currencies or the dollar or the euro, versus a floating exchange rate regime. And that tends to have a certain impact on everything in the economy. And it's important that whether you took macro with me or with Professor Weinke or some other university in this world, you should really have this clear in your mind. And I should stress that there are many ways to do macroeconomics. One way is to write down a lot of equations describing behavior of different households, sector, firm perspectives, and then putting them together in a general equilibrium. Another way is to take something like that and reduce it to a two-dimensional, project it on a two-dimensional surface and look at it as a graph, shifting curves and making statements about outcomes of events that are outside the model. We call them exogenous events, exogenous shifts, policy, shocks, whatever you want to call it. So I'm of the opinion that at the bachelor level, it's really important for you to get an intuition for what's going on and don't spend too much time writing down first-order conditions and learning how to use Dynar to solve these models. That's something you do when you're a master's student, in my view. So I will spend a lot of time reminding you today of how macroeconomists think about the short run, the Keynesian short run, when prices and the inflation rate are kind of given by external influences to such an extent that it's not really worth thinking about feedback on the behavior of prices. And then this medium to long run, which we know depends on the behavior of the central bank and the central bank's target inflation rate or chosen growth rate of the money supply. Nowadays, central banks don't do the latter. They tend to set a target interest rate. So we'll call that the ASAD model. So those two models will be a crash course today. We'll do a crash course on macro in two 45-minute blocks. Maybe I should tell you about the rest of the course quickly. We're going to do that today. Next week we will do a little economic history lesson. What happened after 1870? So Europe really set the stage of world events, believe it or not, until World War II, and then kind of passed the ball to other countries. But at that time, the gold standard was kind of a European call. So using the gold standard as a monetary anchor was a kind of invention of European countries, and it perpetuated itself into the interwar period. And it really had a disciplining effect, but also a kind of a negative effect on the behavior of the world economy. We'll talk about that. And that's kind of what drove us to think about maybe a single currency for Europe, because Europe is a bunch of small countries. Why not do things using a single means of payment? And the question is, who gets to print it? Charlemagne tried to take over Europe and introduce a single currency, and he failed. Napoleon tried it, he failed. Adolf Hitler tried it, he failed. So, I mean, you can't do this by force. It has to be sort of a consensual thing, right? It's like other things in life. It has to be consensual. So under what conditions is it a good idea to have a monetary union? Is China a good monetary union? Is the United States a good monetary union? Could Europe be one? Obviously, France seems to work like a monetary union within the French département or the Bundesländer in Germany. Why is that? Is a sort of a fluid borderline between the two possibilities? And the answer is yes, and we'll talk about this theory of optimal currency areas for a whole lecture. We'll talk about how Europe may or may not meet those conditions. And then we'll talk about this European Central Bank, which to me is one of the biggest forces for European integration today. Okay, so a lot of people complain it's not elected, there's no democracy involved, but actually there is, but it's just very indirect. But it is a European institution that is able to act without going back to the parliament and getting feedback and protests and all the rest. I mean, think of the financial crisis. Think how decisively the euro successfully reacted to the financial crisis. The central bank of the European Monetary Union probably did a better job than the United States, I would claim, in keeping things under control, given that the shock was an external shock over which Europe had no immediate control. And then, of course, the pandemic and the current situation are obvious further examples of that. So we'll talk about the European Central Bank a lot. And then we'll talk about how fiscal policy, as the counterpart to monetary policy coming from the behavior of government, spending and tax behavior, can Europe do something on that dimension? And the answer is, not so much, because there's no European government. And the European budget, through which fiscal policy would be executed, is only about 1% of European GDP, EU GDP. So you can't, you play around with 1%, a fraction of 1%, you're not going to move the dial very much. You need to do better than that. So, Europe is kind of hamstrung. It's going to have to rely on the individual fiscal policies of individual member states in the EU unless there's a coordination of policies. Okay, so we'll talk about that. And then we'll finish talking about the sovereign debt crisis. So that's the roadmap for the rest of the semester. It'll be a lot of fun. And I ask you, the attendance is going up despite this beautiful weather. Please ask questions. This is supposed to be a feedback session. I'm assuming you've seen the video. It's probably a big assumption. Some people asked for the slides in advance. No. I'm a big fan of B.F. Skinner. B.F. Skinner said, if you want to learn something, you have to be behaviorally adapted and kind of induced to learn. And learning means repetition. And learning means looking at things from different perspectives. So sitting in front of me, listening to slides that I've just cooked up yesterday, and then saying, I'm done now, that's not going to cut it. You're going to have to watch the movie, look at the slides, come here, discuss it with us, discuss it with Burda, and then look at the slides afterwards. That's why I post them afterwards. Okay, that's the way I do things. If you don't like it, c'est la vie. You can watch the movie and take screenshots. If you're really into that, do that, okay? But the slides are always better if you come to the live performance. There's new stuff today that is not on the slides from last year, okay? All right, so again, this is about fixed versus flexible exchange rates. I'm going to go rather quickly because I'm assuming you've all had macro before. Now, some of you may have had baby macro, some of you may have taken graduate macro in the United States or, England, I don't know. But I do think that even if you're farther down the road, you should be able to think in graphical terms because the Samuelson test has to apply. If you want to explain it to your grandmother, how do you do it, right? You can use words or you can use pictures. And pictures are very effective. Some grandmothers can understand a two-dimensional graph, x-axis, y-axis, and that's kind of what I go for. I go for the grandmother test. I tried to explain some of this stuff to my grandma, and she was not amused, but I tried anyway. All right. So again, the key thing is Europe is a bunch of small open economies. Even Germany is a small open economy in the world context. So the idea is, how do those economies behave? That's why we're going to use the Mundell-Fleming IS-TR model for the first half of this lecture. Okay, so here's some good evidence on that. Look how small these countries are in relative to world GDP. Look how open they are in terms of international trade, usually measured as the average of exports and imports, or the sum of exports and imports divided by GDP. Okay, here it's the average of exports and imports. So Belgium, huge openness. Obviously, it's a small country, smaller than North Rhine-Westphalia, right? At least in terms of space. Denmark. And then look at Germany. Given how big it is, it's still pretty open. I mean, what am I saying? It's remarkably open for its size. Other examples are less impressive, like Japan. We don't have Greece up there, but Greece is actually rather closed. So there are some deviations. It depends on economic history, whether you have the resources to have an export-based economy, et cetera. But today we're going to talk about what happens when a country like Denmark gets hit with a shock. Okay, and I'm going to talk, at the end of this lecture, I'm going to talk about Michigan, a state in the United States, which is an open economy in the United States, using the dollar with every other state in the United States. So it's a small, open economy, and it got socked with the Great Recession in 2008. So think about that. How would you want to think about that using a picture to explain to your grandmother how it works, okay? So this is, the short run is a Keynesian perspective. We'll talk in the first half of this lecture about the Keynesian perspective, which says that for the next 2 or 3 months after the pandemic shock or a big surge in fiscal spending or a tax cut or a financial crisis, the price level's trajectory won't change very much. So we can kind of ignore it. We can shift 2 curves that have nothing to, that assume that the price level is fixed. Okay, that's the old fashioned. And if you think about it, what you do when you take Lutz Weinke's Euler equation or Euler equation and write it down, it's doing kind of the same thing. Given the inflation rate that's expected, what is the relationship between aggregate demand and interest rates? That's really what it's about. Goods market equilibrium. Now, that means that we're going to be able to cut through a lot of complexity. So again, if you end up in a ministry, if you're working in the economics ministry in some, you're working for the minister or some Abteilungsleiter, okay, you're going to have to give him a quick answer. He's saying, God, we've got a problem. Energy prices have gone up by 10%. And what does this mean? So you can use a Keynesian perspective. That's what we'll probably try to do in the first run. But you might have something where the price level is not so implicated. So like it could be like what would happen if suddenly there was a surge in military spending. Okay, what would be the short run answer you would give to your minister or to the director of your department? So we're going to be looking at things that influence output and interest rates in the short run. Okay, and again, this is a small open economy. So the question is, where does the interest rate come from? Can we actually determine it? That's what we're going to look at. In the longer run, we care about inflation, we care about output growth, and these things are kind of dominant in the discussion. So we'll be using a different framework for that. We'll be using the ASAD framework for that perspective. Okay, so we'll start with this IS-TR, and if you want to review, come to section. Berfin will go through the first steps. You can look at my textbook, chapters 11 to 12, in several editions. The 8th edition is really quite up to date. And then the ASAD model is this model of inflation and output. So you might have seen that also at the end of your course with me, certainly, or with Professor Weinke, or wherever else you did your macro. Okay? And again, we're going to start with IS-TR, get through quickly. But in the long run, we care about inflation. Inflation has reared its head after 20, 30 years of non-existence. Suddenly we have inflation. Where did it come from? Right? Well, we have some good ideas. We'll be able to explain it at the end of this hour. Okay? Why am I doing this? Because I think if you understand the open economy nature of European economies, you'll understand why the fixed versus flexible exchange rate is such a big deal. And most countries in Europe have gone for some sort of fixed exchange rate regime. Some went right away, like Lithuania, Slovakia, Estonia, and so some like Poland said, no, we're going to kind of sit back, and there are ways to explain that, given that they're so open. So here's the IS curve. Negative relationship in interest rate output space, or output interest rate space. Output is GDP. Okay, interest rate is the nominal interest rate, and since inflation is kind of given from up there, it's really about the real interest rate. So this is the behavior of the real economy in response to different levels of the real interest rate. When interest rates are high, the level of aggregate demand is low, and the level of output, when output equals aggregate demand, is low. That's the logic. Cut interest rates, all things given, you're going to have more demand, more output. Okay? Where does the interest rate come from in a small open economy? Well, it depends, doesn't it? Why does it depend? And what does it depend on? If I'm Denmark, yeah. It could depend on Denmark's central bank, but you can't say that unequivocally. because Denmark might be doing something with its exchange rate. And if it is, then it can't determine interest rates. So that's the key thing you should write down right now. If you have a fixed exchange rate regime, the central bank cannot control the interest rate. It has to accept the foreign interest rate from abroad because we have capital flows, we have open economy, right? So Denmark has to choose, do we want to have our own monetary policy and then we let the Danish crown go wherever it wants? Or do we fix the Danish crown and the Central Bank of Denmark is a market maker in the crown, buying and selling as much as it takes, as long as it takes, as long as they have reserves to keep that exchange rate constant. So that's the chilling trade-off. If you're a little bitty country exposed to international capital flows, you can either choose your exchange rate and punt monetary policy, or you can have a monetary policy, you can have your own Taylor rule, but then you have to accept the exchange rate that the market is going to give to you. Okay, now you might say, I don't like economics. I think we should put up some walls and have our own Ostmark or Cuban peso. You can do that, but you won't be trading very much, and you won't have an open economy. So again, this is the stark trade-off that a country faces. You're tiny, you can't influence world interest rates, you're not the United States, you're not the European Central Bank, you're a little tiny country within the European Monetary Union. What are your choices? Okay, so if you're Denmark, Denmark has its own currency. They chose not to join the euro, right? Slovakia did join rather early, so they effectively gave up their central bank. That's the ultimate form of fixed exchange rate. Other countries like Poland keep their currency, have their own monetary policy. So you see the spectrum of trade-offs. Okay, so we interact those two curves together, we see that the international financial market condition is kind of the foreign interest rate, I star, the foreign rate of return that the market is presenting people in my country. So if it's too high, I take my money and run. And if it's too low, people are rushing to get into my country and put short-term capital in my country. When I say capital, I'm talking about short-term bank assets, okay? So again, think about Denmark is classic example for a fixed exchange rate regime inside of the European Union. And then you've got, or Sweden, for example, a floating exchange rate regime, kind of different. Poland, floating exchange rate, or you have countries that actually adopted the same currency. That's the ultimate form of fixed exchange rate. Then you have no central bank really to do anything at all. Okay, so conclude. Fixed exchange rates means output is going to be endogenous, but the money supply is also endogenous because the central bank can determine it anymore. If you have flexible exchange rate, the central bank can determine the money supply or interest rates relative to the foreign rate, but then it has to accept the exchange rate, and the exchange rate becomes endogenous. So this is going to challenge your understanding of what endogenous and what exogenous is. It's crucial to understand Mundell-Fleming. Right? Mundell-Fleming is the same Mundell that you know, and Fleming was this guy at the IMF, famous international economist in the 1970s from the UK. So these Canadian and a Brit basically came up with this way of thinking in the short run about the hard choices, and that's why the IMF does this kind of stuff, because the IMF is in charge of kind of monitoring fixed and versus flexible exchange rate regimes, and countries that try to fix exchange rates get into trouble sometimes, and they may need a bailout. Okay, so the exchange rate regime is the first question you have to ask if you're asked on an exam or a certain, you're reading the newspaper, you're reading the website of Associated Press, and you see that little country's in trouble. The first thing you should ask is Iceland in trouble? Is the exchange rate flexible or is it fixed? Because that determines the constraints that this country is going to face. And to understand those two sentences, which you should look at very, very carefully, you have to look at the balance sheet of the country to understand why that's the case. Because I said already, when the country fixes its exchange rate, it kind of gives up its choice of the money supply and interest rate policy, and you have to understand why that's the case. Now, this is something I've shown to you many times in macro. So I have these three consolidated balance sheets. You've got the central bank, important player, and a small open economy, important player. And you've got the consolidation of all the private commercial banks, financial institutions, savings, Sparkassen, Gestepanio, and all that stuff put together. And when you consolidate, all the intra liabilities and assets kind of disappear, and what's left over is the exposure to the rest of the economy. And on the right-hand side, we've got the real economy. The green stuff is supposed to represent what we call the monetary base. The monetary base is what the central bank can control directly. And remember, this is the central bank creates this money, but it also creates a liability. It's an asset for you and me if we can get it, but it's also a liability of the central bank. And therefore, it appears on the right-hand side of the central bank's balance sheet. Part of that high-powered money is liabilities to other banks. Banks have balances with the Federal Reserve or with the Central Bank of Norway because they need to clear against each other. Liquidity, we call it. And then you've got cash in the hands of us. The stuff that you have in your pocket also appears on the right-hand side of that balance sheet of the central bank. And it appears on the left-hand side, on the asset side, in the consolidated household sector with the government. And you ask, why do you put the government in there? Well, that's just to make it easier for you to look at. But you could separate them. You'd have a government balance sheet and the private household balance sheet. You could have the firm's balance sheet. We've put them all together. Okay, so how do we think about macro policy in this case? This is what you're going to be asking. So why is this so important? Well, if you have flexible exchange rates, you have some monetary policy, and if you have fixed exchange rates, you have the possibility of doing fiscal policy, but these may not be very effective. And we need to understand that, okay, the interaction. So let's talk about monetary policy first. How do we summarize monetary policy in Macro 1, Macro 2? Central banks set interest rates, right? And how do they set them? They set them with a mind to,
They set the overnight rates at which banks can store money.
Right, and they don't just do it arbitrarily, like the guy wakes up, or the Lagarde wakes up and she says, oh, I'm in a bad mood, I'm going to raise those interest rates. So she has a policy, right? And how do we summarize that policy? It's something rule, yeah. Yeah, that's the verbalization of what this concept is. So who invented this idea of how the central bank reacts to its environment and sets the interest rates in a rule-based fashion? Taylor rule. Is that what you said? Yeah. Taylor. John Taylor, Stanford University. In the 1990s, he observed that central banks tend to raise interest rates when things are getting hot, when the economy is booming, and they don't just do it because they're in a bad mood. They do it because they want to slow the economy down. They want to put the brakes on. And if the economy is skidding out into the gutter, they tend to cut interest rates. That's called the Taylor rule. You learned that in Professor Weinke's course. I know Professor Weinke pretty well, and I know you learned it in my course. So don't be coy with me, right? I want you to go back and look at your notes, okay? So the Taylor rule is really the way that we use a simple equation to summarize what the central bank is doing. And that's what I'm going to talk about. So it looked like this, mathematically. The nominal interest rate is based on three things. It's based on a target rate, nominal interest rate. That's kind of like the intercept of this simple linear equation. And then you've got the deviation of inflation from the central bank's inflation target, because central banks don't like inflation. Look what's happening now at the European Central Bank. They're raising interest rates to fight inflation. The Fed is doing it. And then the third term is what I talked about already, leaning against the wind. So the economy is booming, and this is the output gap in parentheses. It's a percentage deviation from the solo trend. Okay, so it's an easy one, right? It's easy to explain to your grandma using this equation. If she knows a little bit of math, she can handle it, and you can draw it, right? So what is it supposed to be? It's supposed to be a rule. It's a rule-based policy. Central banks just wake up and I'm in a great mood, I'm just going to cut interest rates, or I'm going to try to get reelected. Central banks aren't supposed to do that. Now, maybe in some countries they do, but that's not what they're supposed to be doing. So we think of central banks based on rules. It's a stable rule. It's supposed to be about a target rate of inflation. So the central banks don't look at the money supply growth anymore, but implicitly they do because they're trying to peg the inflation rate. We know in the long run that has to have something to do with the money supply. So they're going to do whatever it takes to keep inflation around pi bar. And pi bar is, for the ECB, is about 2%. So you say, well, they failed, didn't they? Well, did they? Well, they have other things too. They don't want to put the economy in the garbage can. So, I mean, they could have fought inflation really drastically. They could have gone for 15% in interest rates. That would have tanked the economy. We'd all be unemployed right now. So, I mean, it's a trade-off. And the central bank has a trade-off in their mind, and this is supposed to summarize it. And that's the way we economists think about it. So the central bank leans against the cycle, and there's a neutral interest rate. I called it a policy or a target rate. It's a neutral rate because if everything's cruising, if pi equals pi bar and y equals y bar, then those terms are contributing nothing to the interest rate policy of the central bank. It's I equals I bar. That's why it's called the neutral rate. Now, some of you may have taken economics macro in a different place and learned about the LM curve. It's kind of a special case. If you know what I'm talking about, great. If you don't, forget it, okay? It won't be on the exam. So that's what it looks like. That's the TR curve. Don't look at her, look at this. Good morning, good to see you. So we're kind of reviewing macro. You took my course, right? So you know all about this stuff. Anyway, upward sloping. TR is positively sloped in IY space. The position of the curve is supposed to represent this target interest rate or this neutral interest rate, because in the long run, if the central bank is trying to choose inflation to be at its target, then the central bank can't choose everything. So there's a real interest rate out there that we know comes from somewhere else. It comes from the real economy. Therefore, the I bar has to derive from pi bar. That's called the Fisher principle. These are all things you've all seen, and I'm so glad you're all here today. It's really great to see all your smiling faces. The slope of the TR curve is exactly leaning against the wind. Okay, so think of this one. This is not a very aggressive central bank. They're basically letting the interest rate, not very, very much, let the economy flop all over the place, you know. We're going to keep the interest rate kind of around it. And a lot of times financial interests like that, right? Because that keeps things stable. If you're in the construction sector, you like that kind of TR curve, but you're not supposed to be able to tell the central bank what to do. We call that a loose monetary policy or a not very aggressive one. This would be an aggressive monetary policy, steep curve. So if you watched the video, you wouldn't have seen this. This is new. Okay? So position and slope are part of the story, right? So we're almost done now. We've got the TR curve, we've got the IS curve, we've got this IFM curve. Just one more remark. The central bank controls the inflation rate in the long run. If Turkey has an inflation rate of 100%, it's Turkey's fault. It's not the Turkish population's fault. It's the central bank's fault. If Armenia has a 30% inflation rate, it's the fault of the central bank. You can't blame the Russians for it, because the central bank of Armenia controls the growth rate of the money supply. And they do it because they're controlling it to control the inflation rate. So every central bank gets the inflation rate it deserves. And that's why we focus on this pi bar. That's a policy choice for the central bank. It could be a political choice. So if you're in Turkey, obviously some other people have some influence on what they're doing, and that's why Turkey has a high rate of inflation. That's the way it is. And because of the Fisher equation, the real interest rate is given from outside, so the inflation rate's choice implicates the choice of a target interest rate. So the central bank doesn't have so much freedom. It can choose one, it can choose the other, can't choose both, because that would mean choosing the real interest rate. It can't do that. And the real economy determines the real interest rate. Okay, so this is kind of this is going to help us later. We move to the world with inflation. But right now, inflation is given. So all that stuff with pi in it collapses to a constant. And that's why we can plot this in the IS-TR mode. We can put it in a single picture, because we're going to ignore inflation in this very short run, from quarter to quarter. And you say, well, how can you ignore inflation? Well, you can in a lot of circumstances. And if you can't, then you have to use IS-TR. So the complete system looks like this. Okay? All that's left is to determine whether or not the economy, which is open, has flexible or fixed exchange rates. That's crucial. I already said that. Because if you have flexible exchange rates, you can choose a TR curve, use central banker. But if you have fixed exchange rates, the TR curve disappears. You cannot set the exchange rate and control interest rates in an open economy at the same time. It's been tried, and it doesn't work. We can tell the story why. If you try to set a lower interest rate than the world interest rate is willing to accept, people take money abroad. And that puts pressure on your exchange rate. The central bank has to, and if it's trying to fix the exchange rate at the same time, it's going to lose foreign exchange reserves because it's going to be buying back its own currency using its valuable foreign exchange reserves. Okay, so this is Europe took many, many decades to learn this. But the world has taught Europe as a collection of small open economies trying to fix their exchange rates and trying to say we have monetary policy too, that it doesn't work. So it's a hard choice. So we say that the TR curve doesn't exist in the case of fixed exchange rates. That's all you need to know, right? You can ignore the TR curve. Belgium, when it had the Belgian franc and was fixing to the D-mark, and now it doesn't even have a central bank that determines any exchange rate. The exchange rate is fixed. Basically, it's an intersection of two curves. The IS curve, equilibrium in the goods market, and the foreign interest rate as determined by the IFM curve. Okay, so we can do this already. We can already understand a lot. Small disturbances, big disturbances over the short run when you have fixed exchange rates. Okay, so consider starting from this point. And suddenly we have an increase in demand. It could be originating at home. Remember, the IS curve is C plus I plus G plus X minus Z. So there are lots of different sources of demand shifts. Just consider the case I discussed already. So the big surge in government spending. Maybe the government wants to buy a lot of solar collectors and put them in Berlin. Put them on the roofs of our universities to make our operating costs lower so we can have more professors. Okay? That would be a rightward shift in the IS curve. All the previous conditions, all the previous points representing equilibrium in the goods market are no longer equilibrium because the government is suddenly spending at all levels of interest rates more money. It's injecting more G or I, whichever you want to look at it. Maybe it's really I, but it would be government investment. It would be government spending, shifting the IS curve to IS curve prime. So what do you observe? You observe a big expansion of output. There's no feedback of rising interest rates that would depress demand for other reasons. There's no Verdrängungseffekt. The multiplier is the full multiplier of the spending increase, incorporating the fact that there's a circular flow of spending as well. Okay, so we have a large increase. This is why fiscal policy under fixed exchange rates, even in a small open economy, is effective. It's also why it goes in the other direction. So if the demand for goods and services in a country collapses because of a financial crisis, because the IMF insists that you have austerity, you have it going in the other direction. And it can be very intense. So Greece suffered greatly because of the austerity programs of the IMF. And it was like moving the IS in the opposite direction. They got the full blow of these spending cuts, immediate, and it was very painful. Okay? So we have the full effect. And then you say, okay, what about the TR curve? There is no TR curve. If there were one, it would have led to an interest rate increase, and that would have caused capital inflows. And in a fixed exchange rate regime, the central bank would have had to buy those capital inflows, increase the money supply, reduce interest rates till you get to B anyway. Okay, so the TR curve is no longer really a policy choice. So if you want to dream about the TR curve, it's a ghost moving to the right until you get intersection at point B. The ghost of the TR curve. Okay, but that's only when you have fixed exchange rates. It's not that way in a flexible exchange rate. And if you want to trace through the mechanism, that's what I write right here. The central bank basically, to the extent that there are capital inflows, it just buys them up because it's fixing the exchange rate. You don't have any monetary policy. Okay. Now, if you didn't have capital mobility, so if you had a closed economy, it would be a different story. This is maybe what you learned when you took sort of super baby macro. Okay. So suppose you really had a TR curve and there were no capital flows coming in from abroad or going out, then basically you have an increase in GDP, but it doesn't increase to the full extent because you have crowding out. The increase in interest rates depresses some of the other demand in the economy. So this will be less consumer spending, less investment on the private account coming from other sources in light of this increase of government purchases at all constant interest rates. Okay? We can also think about a financial disturbance. So this is a really interesting question. Suppose you're here, and suppose it's not your fault, but the world level of interest rates rises. And this is happening right now. The U.S. decides to raise interest rates. You're sitting here, you're pegging your exchange rate to the United States. There are several Latin American countries that do that. So what happens? Okay. The IMFM curve shifts upward. So you're faced with this kind of brutal decision. What do? Do I want to maintain the fixed exchange rate regime? I have to sell dollars, buy back my own currency. I have to effectively move to the intersection of the orange and the blue curves if I really mean it seriously about fixed exchange rates. So I have to put my economy into the ringer. I have to torture my economy. I cause a recession. You could always blame the U.S. for it. This has happened in Europe as well. When the central bank, the European Central Bank raises interest rates, a country like Denmark has no choice but to accept those higher interest rates. Because Denmark has its own currency, but it fixes it to the euro. Okay, so that's the dilemma of having a fixed exchange rate regime. You're subject to the vagaries of foreign nominal financial disturbances. So you can see it's not obvious. People say, "Oh, you got to have fixed exchange, you got to have floating exchange rate." No, it's never obvious. It's never unambiguous. There's a trade-off. Okay. So again, in graphical terms, you can see that we have the central bank's behavior means they don't have a TR curve because they're actually out there selling their foreign exchange to keep the capital outflows from causing a depreciation of the currency. Because as capital flows out, their people are selling their currency for the foreign currency, and that will cause the domestic currency to depreciate. So we end up, to defend the currency means having a recession. It's not so great. That's one of the disadvantages of having fixed exchange rates. You don't have any control over your money supply and your monetary policy. So as the heading says, the rates of return on foreign assets determine the domestic level of interest rates. Now you could do something else. You could say, I'm going to throw it away. I'm going to depreciate. I'm going to have flexible exchange rates. I promised you fixed, but I'm going to let it go. Okay? So we know that has a different outcome. So this outcome, basically the central bank says we're going to continue on our interest rate policy. We're going to have our TR curve. And therefore, we're actually going to have a depreciation. Capital flight from my country causes our depreciation, and that increases the demand for our goods and services. And as you will see in the problem set that you will look at on Thursday, the IS curve shifts to the right because of the depreciation. Our goods are cheaper, foreign goods are more expensive, the IS curve shifts to the right. Okay, so that's why Milton Friedman said, hey, we really want to have flexible exchange rates because it means that the financial consequences of a foreign shift will be buffered by the exchange rate. Will help us out of this problem. We don't have to have a recession because the U.S. raises interest rates. We'll just depreciate. Okay? That's the good side of having flexible exchange rates. Okay, and you can also think about a devaluation. I'll skip this because it's, I just repeated what I just said, but it's the mechanism of how it happens. For those of you who took macro for maybe at a different university, you can look at it in a detailed way as the accommodation of that increase in sales of the foreign currency. Okay, so how does it look if we're in flexible exchange? I already kind of led into that. You can see there's an advantage. We can actually look at it in detail. You now have the Taylor rule, as I said before. In the background, you've got basically demand for money. So the money demand curve is there. The interest rate determines how much money people demand. But the left-hand side of this picture can be ignored because we think that the Taylor rule is calling the shots. So you can ask what happens if the Taylor rule just shifted. So suppose you're a central banker and you suddenly decide at all levels of output, I'm going to reduce interest rates. Okay, so I'm going to shift the TR curve, and I'm going to shift it in an aggressively expansionary way. Okay, so at every level of output, I'm going to cut interest rates. So it's like decreasing the target rate, and you can see that causes the whole curve to shift to the right, and the IS curve is the condition for goods market equilibrium. So we see that interest rates will fall. We'll have more aggregate demand. We'll have an expansion. So you can interpret this as what Erdogan did in Turkey, or what the guy in Mexico did a few years ago. You're cutting interest rates at all levels of output. It's like shifting the Taylor rule, okay? You can do that because you're the central banker. You can choose your target interest rate. And you may have consequences. In 2 years, 3 years' time, you might have some inflation, but we're in a world where inflation is out of the picture. We're just focusing on a fixed price situation. Now, as a consequence, interest rates are lower, but we're an open economy, so people are going to be selling our currency. So that causes an extra kick to the effect, because our currency is depreciating, our goods are cheaper abroad, so suddenly we're a bargain. Foreigners want to buy our stuff. Locals aren't buying foreign stuff, so the IS curve shifts on top. Okay, so it's a double whammy. C is not the end point, because we know we have to be on that IFM curve. So the depreciation moves the IS curve to IS prime. So monetary policy is really effective. And that's one reason why Milton Friedman, the defender of monetary policy autonomy, was saying that this is the effective way to do things. If you're an open economy, you can influence the exchange rate. So now you see the picture. It's basically about, if you have autonomy if you have floating exchange rates, you're going to have some monetary policy authority, and a small open economy can move things around in the short run. Now, the shadow side of flexible exchange rates is if you have a boom, the exchange rate is going to choke it off. And if you have a depression, the good side of things, you'll have depreciation, and that will stimulate some exports. So again, it's kind of it's a matter of what you put your weight on, and you can see that by looking at this. So consider now a shift in the IS curve, as we discussed before, a big investment boom. Maybe the government wants to invest in solar panels. IS curve shifts to the right. Interest rates rise. That induces capital inflow. Our currency appreciates. And as a result, the IS shift gets kind of rolled back. It's called crowding out. The appreciation kind of ruins the party. This happened in the United Kingdom in the 1990s. Economies that are doing well tend to have appreciating currencies. And that's just an observation, but we have a good reason for it. Interest rates are higher at home relative to abroad. And when the exchange rate is floating, you got to accept that's going to lead to an appreciation. So the IS curve shifts back. Okay, so this is all in. So we can summarize this in the following table. This is why it's never unambiguous. What do you like? Do you want to have? Do you want to do something about monetary shocks, or do you think you're facing more monetary shocks in your world, or do you think real shocks are more important? Well, that will kind of determine whether you prefer fixed or flexible exchange rates. And that's going to come back to us in a couple of weeks when we talk about optimal currency areas. Are there any questions right now about this? Do you have a question? So it's a lot to think about, but it's really, it's putting everything in a box. It's a 2x2 table, right? 2 of them. And you can summarize it with a list. The advantages of fixed exchange rate regimes and the disadvantages. Okay, so fixed exchange rate regimes, I showed you already. Financial shocks at home will automatically be buffered, but real shocks will get aggravated, makes fiscal policy and fiscal stimulus more expansionary, because you don't have the interest rate as a brake. I'll show you next week that it provides stability of the real exchange rate, which a lot of producers like. French producers like to know that the German competitors are not getting a free lunch because of a depreciation, right? So that's why we've had a stable French franc, Deutsche Mark exchange rate for more than 20 years now, actually more than 40 years if you look really carefully at the data when there was a Deutsche Mark. There is no Deutsche Mark anymore, but in our heads we still have it. Now we can compare price levels and see what they do. If you have flexible exchange rates, if you're Milton Friedman, rest in peace. Every country has its own central bank. Ooh, yeah, central bank. What, big deal. You put your queen on the bill. A lot of people like that. Look at the queen. Well, she's gone, but you put somebody else on there. Can't wait to see who they put on the Bank of England banknotes. But that's part of it. If you have monetary autonomy, you can print your own banknotes, and you can control your own monetary system, and you have monetary authority. You can raise interest rates when you want. You can have your own Taylor rule, however you like. Can't do that if you have fixed exchange rates. But you have fluctuating exchange rates, which means your producers are going to complain, and you're going to have financial hedging because the exchange rate fluctuates. If you want to buy something in the future, you have to insure yourself, so you need to hedge. It's expensive because you have to deal with banks. Okay, so the world is not really clear on this. You have to decide. So if you become a politician, you're going to have to decide this. Europe has decided to have mostly fixed exchange rates. Now, I'm about to move into the more interesting part of this analysis, which is what happens if we start thinking about inflation on top of this, because we've ignored inflation. And it's a good starting point. You can do a lot with IS-TR. And if you have a computer, you can solve a little system of equations. But still, you want to think about inflation. It's a mistake to ignore inflation, right? Because inflation does start to react, even if you're talking about a time span of 6 months or 12 months. And remember I talked about Michigan. Michigan has a common currency with the United States, with the rest of the 49 states. It's exporting and importing a lot. There are no border controls. We don't even know what exports are in Michigan, but we know that they're important. You just have to ask a manager of GM that's important. Okay, so what happens if there's a depression in Michigan? Well, we learned before that the effect on GDP in Michigan is going to be large because you have full multiplier, you have full capital mobility between Michigan and Wisconsin, Illinois, whatever. Hi, have a seat. Just don't come through here. Okay. But if we assume that prices are fixed, we're probably missing something, because maybe price adjustment might be part of the story. Maybe Michigan is getting in such bad shape that they start cutting their prices. Maybe wages start to fall, So we really have to expand the analysis, and that's why we want to think about the long run. And it's not necessarily the truth that if you stick with the IS-TR that you're going to get the right answer. So we need to think about the price level and the inflation rate especially Okay, so we're going to use the ASAD for the rest of this hour. And again, I talked about Michigan. So think about Michigan carefully. So fairly populous state, probably about as big as North Rhine-Westphalia, has a few million people there, center of industrial activity, big auto producer. The Great Recession really hit Michigan hard because the financial crisis meant people couldn't borrow money to buy cars. America, cars are important. Lousy public transport. So you got to have a car. There are a lot of cars in the United States, okay, with all the consequences for climate, et cetera. So having a car is important. And if interest rates rise, you can't buy cars anymore. And interest rates rose in Michigan because banks didn't want to lend to anybody. So GM Bank, no loans. So people didn't buy. So using IS-TR says IS curve radically to the left. Big shift to the left. Unemployment rose, GDP fell. Michigan was hit relative to all the other states very badly. Obama actually nationalized General Motors. So General Motors was owned by the US federal government, went into receivership, or a mild form of bankruptcy, okay? And that has political implications, of course. So how do you do this? How do you save them? How do you restore equilibrium again in this open economy with a common currency? That's the ultimate fixed exchange rate, right? So a dollar in Michigan is the same as a dollar in Wisconsin, as in Illinois, New York, California. The same thing is true if you just think of Greece, Germany, Italy. It's the same thing. Yeah.
But is it really the same if, for example, France has a much higher price level than Germany and Slovakia has a much lower price level? Because nominally, €1 is the same in all three of those countries, but in real terms, you get much less in the basket.
The purchasing power might be different, right, but if you compare Germany and France, the purchasing power is almost identical. The real wage in Germany and France, if you take the average industrial worker, it's almost identical. So I would vigorously refute the example of France and Germany. Go to Slovakia. Why is the price level lower? Because non-traded goods are cheaper. So it's the non-traded goods that make the difference in the basket. And you can't arbitrage non-traded goods by construction. So the reason why if we go to Poland and look around in Poland, you're going to find that prices are lower, but it's prices of bratwurst, sausages. It's not the price of manufactured goods because there's a law of one price. The Poles can easily export to Germany and get the same price that they could get in Poland, right? There's no goods arbitrage, goods market arbitrage. Okay, so the point is simply, how do you restore equilibrium in a world like that? Well, something's going to have to happen that we haven't thought about, because otherwise Michigan's going to be stuck in this terrible situation for forever. And the IS-TR is inadequate to capture the adjustment processes that we talk about, right? So what are those processes? Most importantly is the price level is going to change. There will be some price adjustment. It won't be forever, but there will be some slowdown in inflation. There will be some absolute drop in the price level, wages will fall. So we need to move to a different set of curves. So we're going to look at this one. This is the second stage of macro in my course, and it's the way of macroeconomists like to look at this medium run, because then we can capture inflation, and we can think about output at the same time. Okay? Now, we can put output on the horizontal, and then you have Y bar, because we know that Y bar is the center of gravity, if you like, for the economy around the solo trend, but this thing is growing every year. It's growing every year, so we have to track it. So people at the IMF and the OECD would put output gap on the horizontal to make it easier. Then it's basically the fluctuations around the Y bar, which is a moving target. So we'll do that. Okay, so what's the point of doing this? Well, I claim this is a great way to sort out the world. If I just want to look at something like an observation, it's a way of making sense of the data. So I try to sell this in the first instance. I see output rising and I see inflation rising. What's going on? The ASAD will help us explain that. especially if I go to the OECD and get the numbers. So I took Germany in 2010, and there's the number of euros in 2010 prices. I see 2.5 trillion euros. And then it rose to 2.55 trillion in 2011. Remember, these are rates of production, so it's an average of 4 quarters at annual rates. So that's GDP of Germany, 2010, 2011. And in that period, inflation rose by 1 full percentage point, the inflation rate. So in pie output gap space, we moved to the northeast. Okay, so this is a fact. I mean, I actually went and got the numbers, and the OECD tells me that the output gap was minus 1.6% in 2010. Germany was under potential, and then afterwards it was slightly, probably statistically insignificantly higher than potential. Okay, what do you observe? What is the correlation of that movement? It's positive, right? Inflation's rising, and output gap is rising in the sense of output is getting more and more robust. Okay? The ASID would say what? The predominant shift is the AD curve. Okay? So helping us sort out that movement would say that the AD curve's movement was predominating. It was dominating over that period. So this is a really subtle argument because I can bring in more information and identify those shifts. But the logic is if I have 2 curves that are approximately linear and an increase in one, in both variables are observed, then it must be the demand curve that was shifting. It can also go in the other direction. Okay? So again, this is a factual interpretation of what was going on in Germany in 2011. Useful, because we know that Germany had an export boom in that period. China was coming back and buying lots of machine tools. The United States wasn't coming back very robustly, but the world economy was recovering, and Germany was well posed in export mode. So for analysis of Germany, it works pretty well. Conclusion would be inflation and output move in the same direction. It's probably more due to a shift in demand than a shift in supply. Now, both could be shifting, so we have an identification problem, econometrics. If you know some econometrics, you know what I'm talking about. But primarily, the dominant shift was the demand curve. And this applies to Greece in the other direction after the financial crisis. Output dropped drastically, inflation plummeted, so it's a negative demand shift. Pretty useful, right? Okay, well, how does it work if it's a supply shift? And this would help us understand the oil and gas problem we've had in Europe in the past couple of years. So here's Greece in 1990. 1989 to 1990, we observe a decline in the output gap, something like a recession, or the onset of a recession. Greece was really overheated in 1988-89, according to the OECD. Inflation rises from 13.7% to 26.5%. So you think you got it bad. I mean, in 1 year, the price level rose in 1990 by 25+%. That's a lot. And then that's an average price, because the price level is an average of prices weighted, so some prices rose a lot more. And wages were rising in that year too. But they were rising before. So do you think Greece had a fixed exchange rate back then? No. Kind of hard to maintain a fixed exchange rate under those conditions. And later, Greece would join the European monetary system. And we'll see about that later. Okay, so these are different days. So what was the big event, you think, that was going on back in 1990? This is before you were born, probably, but it doesn't matter. Economists have to have a little history in the back of their heads. Anybody take a guess? Yeah, right, the Gulf War, good. Associated with a big increase in oil prices. So the Gulf War induced a spike in oil prices like we saw last year, And gas was not produced in the same way, but here it's petroleum. Greece is a big importer of energy. Workers were also going on strike because they didn't like that, so they tried to get a nominal wage increase. So several things were happening at the same time. Okay, so it's clearly not, it's not like the other one. And I would make arguments that it looks like a shift in the aggregate supply curve. If you remember what that is, think of the new Keynesian Phillips curve in output space. Output inflation space means that in that period, there was a shock to the price level, which translated into an increase in the inflation rate. That would pair up very well with what happened in that year, 1990. The price of oil spikes. Greek workers have just a massive strike. Government spending increases to pay those workers. So you see that, you can interpret this as primarily a shift in AS, but clearly the AD curve probably shifted as well. And if you want to learn more about that, if you're a scientist and you want to try to decompose that shift, you're going to have to get more information, additional information. It's not going to be enough just to look at two variables. You're going to get some external information, identification. Okay? So it looks like a shift in the supply curve. And that's how people interpret this year for Greece. Right? Inflation rising, output falling. Looks like Europe last year. Right? For most European countries had a technical recession at least. Now, why was it only technical? Probably because the European governments were increasing spending to fight this, transferring money to people, paying their gas bills, whatever. So it's not completely on the backs of the households. But it looks a little bit like what we had last year, doesn't it? Big, sharp increase in it. And the question is it permanent or not? And so what determines whether this is a permanent increase in inflation in Greece or not? So now I want you to go back and think about what we talked about with the Taylor rule. Yeah. The central bank will be decisive. If the central bank says, oh, okay, we're going to just accept 26% for inflation forever, and we're going to do whatever it takes to keep it there, meaning that we're going to keep interest rates low, blah, blah, and then eventually they'll go up again, and we're going to have 26% inflation forever. The central bank is probably not doing that. They're probably saying, no, we're not going to do that. We're going to raise interest rates. We're going to fight this. And if people's expectations accept that, then the curve will not permanently shift to that higher level, because the shift of the supply curve is about people's expectations. The anchor of the AS curve is the expectation of inflation, the average rate of inflation that people expect, workers, firms, and that depends on what they think the central bank is doing. Right, so the central bank's behavior determines the position of the AD curve, but the expectations of the central bank will anchor the AS curve. Okay, so this is kind of interesting, right? And I haven't written down any math. I mean, this round. But all these curves can be rationalized as behavior of households and firms or the behavior of the central bank. Okay, so the ASAD is just a shortcut for people of the bachelor level who just want to make sense of the newspaper and maybe talk to their friends about it. Think of the demand curve as being the same thing we called the IS curve before, except now we've got inflation as an argument, because the inflation rate affects two things I'll talk about in a second. It affects negatively the level of aggregate demand, and the supply side is basically the willingness of firms and workers to put the dinner on the table, to produce the goods that land in the stores and get purchased in the markets. Okay, so again, as in IS-TR, the regime is crucial. So it depends on whether we have flexible or fixed exchange rates. Because if you have flexible exchange rates, the effect of inflation on aggregate demand will be different than if you have fixed exchange rates. If you have fixed exchange rates, an increase in inflation means immediately that the real value of your foreign exchange rate changes. Your goods become more expensive. Foreign goods relative to yours become cheaper. So sigma, the real exchange rate, changes immediately. So that would say that under fixed exchange rates, you've got a negative slope for the AD curve automatically. So if you're in Belgium and suddenly the inflation rate rises for whatever reasons, demand will be lower because Belgium is completely open and they're using the euro. That's the most fixed exchange rate you can imagine. Okay? So that's one reason the AD curve would be negatively sloped. But if you have flexible exchange rates, it's a little bit different. Then the central bank is in play. The central bank raises interest rates. That causes interest rates to rise. That causes demand to go down. And therefore, the negative slope comes through. It's sloped negatively for a different reason. So if you remember your macro course with me or with Professor Reinke, you'll remember there's a mathematical way of expressing that. And it has to do also with the foreign rate of interest and an uncovered interest parity condition. Okay, but don't worry about that right now. This is harder. The supply curve. Why is the supply curve upward sloping? Well, think about people decide to supply goods and they need to have factors of production. They have to hire the workers. They have to hire the machines. And those decisions are taken in period T, and then T+1, the stuff comes on the table. You have to have an expectation of what the inflation rate's going to be. So the higher you think the price level and the rate of inflation is going to be in the future, the more likely it is you're going to be able to make a profit in the next period. Okay, so all things given, firms work harder, labor works harder, capital is used more extensively when inflation is higher. Okay, so and it has to do with lots of details that we've talked about in the course, in the macro course. So to summarize, we've got this way of summarizing events, interpreting what's going on, and the only thing you need to do is to organize your thoughts is to know where these curves are positioned, because that's the hardest part. What determines the position of the curves? Let's start with the easy one. The long-run supply behavior of the economy should be independent of the inflation rate. In the long run, money is neutral. Monetary policy is neutral. So it should be like this. It should be vertical. Okay, so that's the behavior of the economy around the long run. And if we've normalized it to be the output gap, then it's around 0. You're always going to wind up back on that curve in the long run. That's why it's called LAS. Inflation is a monetary phenomenon, and it can affect the supply behavior in the long run. You can't fool workers to work harder by giving them 15% inflation. People kind of figure it out at some point. They want a real wage. They want a real rate of profit if you're running a company. Okay, and it's all about Y bar. So monetary policy can affect Y bar. We learned that at the very beginning of the course. Okay? What else anchors the system? Well, you've got expected inflation of the firms and the workers. So you and I, and we read the newspapers and we hear the European Central Bank says 2%. I don't believe that we can expect 2% next year. I still think inflation is still going to be higher than 2%, even though they're trying. So when I negotiate with the Humboldt University, I'm going to try to get a real wage increase. If I have some bargaining power, and I don't have any bargaining power, so I'm probably not going to get a real wage increase. But if I did, I would try to, right? Because I have this higher expectation of inflation. And the same thing is true with firms. The kiosk down there, when I just went to, a bottle of beer costs 3 euros at the Späti now. Where does that come from? Part of that is forward-looking behavior. This is time for them to increase their prices, right? Because they know that people have they kind of expect, well, I think I'm going to get a raise. I'm not going to change my behavior very much. And they do have a cost problem. Okay, so in a sense, inflation expectations have kind of moved a little bit. So we call that, this expected inflation term, we call that pi tilde. So it's the anchor that determines the position of the AS curve. And then, of course, the AD curve depends on what the central bank is doing, fixed exchange rates, foreign exchange rates, flexible exchange rates. If it's a fixed exchange rate, then what matters is the foreign rate of inflation. So the Belgian inflation rate is higher than the German rate, then the Belgian price level is rising more rapidly than the German price level, and therefore Belgian demand will move to Germany, and Belgian exporters will have problems selling their stuff. So this curve, the position of the AD curve in a fixed exchange rate regime will depend on this pi star, which is inflation abroad, or if you're setting your own monetary policy would depend on pi bar, which is the target rate of inflation. So very important thing to think about. So we can write these anchors down using the ASAD picture. That's the one I already showed you. We can think about this one. The position of the AS curve is determined by my expectations of inflation. So the higher my inflationary expectations are, the more to the northwest the AS curve will be relative to its position there. So getting people not to expect inflation, anchoring expectations is a real objective of central banks. So if you listen to Lagarde talk, she's always talking, we're going to fight inflation, we're going to do all that it takes. She needs to do that to convince us that she's paying attention. And some central banks in the past 200 years have just said, don't worry about it. We'll just sail through this. And then people say, oh, they're not taking it seriously. Then I'm going to expect more inflation, and I'm going to ask for higher nominal wages. I'm going to raise my prices to protect my real profits at a higher rate. Okay, so then the final one is the position of this curve. And as you can see, when output gap is 0, the inflation rate should be equal to the foreign rate if we're in a fixed exchange rate regime, or the inflation rate should be validated by the reality of inflation if central bank is setting monetary policy. Central bank can't fool you. That's why if the ECB doesn't do something to get inflation down to 2%, pretty soon people are going to start saying, Lagarde, I don't believe you. I'm going to expect 3%, 4%, because my family needs food, right? So I'm going to ask for higher wages, nominal wages, and you're going to see more strikes, you're going to see more industrial activity if you can get away with it. So, as you can see, the Taylor rule is really important in this story. It's really important. So don't forget it, right? 3 components. One component is this neutral interest rate. The second component is the deviation of inflation from its target. So the central bank will always lean against the wind in the real output sense, but it'll also lean against the inflation wind. So one way of interpreting the Fed raised interest rates by like 350 basis points in a year. That hasn't happened in like ever. I don't think it's ever happened at that rapid a rate, okay? And it was kind of a shock, and we had a bank failure, 3 bank failures as a result, because the banks didn't expect it either, okay? So you can interpret that as a positive B and a positive A. And of course, we have to figure out what this pi bar is, and maybe it's not even constant. Maybe Lagarde changes her mind and says, I don't care about inflation anymore. I'm just going to let it happen. Could happen. Shouldn't happen. She's a very credible person. Jerome Powell's a very credible guy. So you want to have credible people choosing pi bar. Stable rule, target inflation, neutral interest rate. And if you want to think about the old LM curve, you can, but I would suggest you not do that. Okay. So we've got aggregate demand, we've got aggregate supply, we've got an inflation rate determined, and we've got output at 0 would be the kind of the equilibrium, the starting position, right? So I've really given you a crash course, and I see you're all kind of crashed right now because I've really laid it on thick, but it's not really hard stuff, and we've done it before. We can use this to think about Michigan now. We can use this to think about Michigan. So how would you think about Michigan using this picture? Now remember, Michigan is a state in the United States. It's open, fixed exchange rates, open economy. Michigan has this crash relative to the U.S. economy, which is also kind of hit by a negative shock. But Michigan was really hit hard. Which curve would probably shift? Anybody? Which one? Yeah, right. That's the obvious answer. The AS curve is, it's hard to tell a story that the financial crisis would have affected the AS curve immediately. You can tell some stories, but they're not really solid, like no more loans, no more demand, C goes down, so you'd have a shift to the left. So what do you see that's different here? You see that along the AS curve, inflation would be falling. As the AD curve shifts, you suddenly have a new variable to pay attention to. So the inflation rate in Michigan would be lower than it is in the rest of the United States. Now what does that do? That actually helps Michigan, doesn't it? Because Michigan stuff is more competitive vis-a-vis Wisconsin, Illinois, California. Okay? So the hope would be that would be like a buffer or a sort of a cushion to help Michigan out of this crisis. You'd also see a recession, but it wouldn't be as bad. What could Michigan do against that? Well, it could do fiscal policy. Okay, so I have an example here of what fiscal policy would look like from this point. So then you have a rightward shift of the AD curve. But you know, that's not the end of the story. Just like the Michigan story is not the end of the story either. You move to point B, agents expected inflation at pi star, but it's actually higher. So what do you think they're going to do? They're probably going to react, just like we're reacting right now to the inflation in Europe. It's kind of making us a little bit nervous. Maybe we should start, well, we're going to have to deal with inflation for many, many years now at higher levels. Okay, because Michigan is just a small drop in the U.S. ocean. It's not going to be able to affect monetary policy. So what do you think? If they do, then we have to let the curve shift. We have to let the AS curve shift. So suppose people are really just backward looking and they just say, okay, last period's inflation at B is going to be the new intersection, the new position of the AS curve in the next period. Okay? That would imply that AS moves to AS prime. So what do we observe? We observe output now falling. Inflation continues to rise. So we end up getting something like a stagflation in response. Maybe kind of similar to a lot of what we've seen in the past. So the first instance, everyone's happy. Output is growing. Inflation's a little bit higher. This reminds me of Greece in 2005, maybe. Okay, and then eventually we wake up and realize that inflation's higher and people start asking for higher wages. The AS curve starts shifting to the left. And you'll see that it continues to shift. But if it's a fixed exchange rate regime, we have to be back at pi star. Because the target rate of inflation is not going to change. The U.S. government is not going to react to Michigan. So eventually Michigan's going to have to restore an inflation rate at home if this is a fiscal policy expansion, or Greece. So it's going to have to do sort of a loop-de-loop from A to B, maybe to C, and then maybe for some period be underneath A, right? So we end up having this sort of like a snail form adjustment, counterclockwise. So this is kind of the ultimate lesson we learn from looking at the world through the lens of the ASAD. Fiscal policy is effective, would be effective for Michigan, for Greece in the short run, if you can afford it. How do you pay for it? Now, again, this is going to come up in about 4 weeks when we talk about Greece and the financial crisis. How would Michigan afford to do this? They have to borrow money. They can't just print money because they're not allowed to do that. They could borrow money in the capital markets. Can you borrow money just for any old purpose? Normally people say, how are you going to pay this back? So how are you going to pay it back? You're going to have to raise taxes. And raising taxes would shift the AD in the other direction. Okay? Maybe Michigan can hope for a grant from the United States government, some sort of freebie, like a transfer. That's possible. But you can see that fiscal policy, even though we know it's more effective under fixed exchange rates, you got this problem of paying it back. The budget constraint will bite at some point. Okay? So, and if it's a small open economy, maybe that multiplier isn't even very high. So there are all sorts of problems with Michigan right now. Michigan is suffering. It's a recession. Flip it in the other direction. Can it cut taxes? Next week we'll talk about that. What can Michigan do? It can wait it out. It can ask for help. can let wages and prices adjust. It can try to do some fiscal policy like this, but you got to pay it back unless you can. And this is what Greece kind of did too. Greece ran up really high debt and ended up not being able to pay it back. So be careful. We know that fiscal policy is effective when you have fixed exchange rates, but it presumes some sort of financing that you can access your domestic capital market, and the capital market won't punish you and charge higher rates of interest. Okay, so just to finish up, we need to talk about what shifts these curves. Just like with the IS-TR curve setup, we need to ask what's shifting AD. And I've already given you lots of hints, right? Under flexible exchange rates, it's monetary policy. Under fixed exchange rates, it's fiscal policy. So if you can look at the math in the background, you can see what's feeding into those shifts. Fiscal policy represents temporary shifts because you can't just keep increasing government spending forever. You're eventually going to have to pay it back, but also you're going to have to go back to some normal level of spending. So every fiscal shift is going to be a temporary shift. A change in monetary policy, on the other hand, is also going to have only permanent effects if it's an increase in the target rate of inflation. So if Lagarde says, okay, I'm going to do an Erdogan and we're going to have 25% inflation, she could do that. She would cut interest rates or just leave them very low. They're negative right now in real terms, right? Even though she's raised interest rates. This would cause the European economy to do much better in the short run, but we're going to have inflation at a higher level in the long run. So that would be a rightward shift of the AD curve. So under flexible exchange rates, fiscal policy is less effective for reasons we've already discussed. And basically, we've covered all the bases now. We've covered the open economy. We've covered the IS-TR. We've covered international capital mobility. A lot of material. Most importantly, next week, we'll talk about Michigan's adjustment. And I want you to think, not Michigan, I want you to think of Greece. Okay? Greece, the financial crisis, austerity, leftward shift of the AD curve, and a depression, because that kept coming back for more, right? And then the Greek government raised taxes. Tax increases contractionary. They raised the VAT, and people started to have to pay it for real. That means even more leftward shift of the AD curve. In the end, you end up having, and the good news about this is that the framework does work. I've been teaching this course for like 20 years now and more. And when the Greek crisis occurred, I kind of was nervous because I said, is inflation really going to slow down in Greece? Is the inflation rate going to go negative in Greece? And indeed, it did. And the economy was in the tank, but it's coming back now. And it's coming back because there's foreign direct investment in goods that are exported because the Greeks have had a real depreciation. So the model does work. Sometimes you have to hold your breath, okay? So it is a pretty good, I mean, Portugal, the same story. Portugal and Spain, all these countries that were suffering are doing much better than Germany right now. But it took like 10 years for this to happen. Good. Okay, so lange Rede, kurzer Sinn. Lots to think about. Please come to the section. And next week we'll talk about the gold standard. We'll talk about economic history. We'll talk about the Bretton Woods system, all interpreted in this macroeconomic framework. So, until the gold standard was abolished or abandoned, we didn't have inflation. Inflation is a phenomenon that came about because of the end of the gold standard. So you might say, well, wow, what does that tell us? Well, I mean, there's some advantages to having paper money, fiat money, central bank money, because you have more flexibility to react to financial crises, for example. Okay, so keep that in mind. That's part of the story. I'm not at all advocating a return to the gold standard, but you need to understand why inflation in France and Germany and the UK was literally zero, or maybe 1% over 50 years, between 1870 and World War I. Okay. And have a great week, and don't get a sunburn. See you later.